Now let's talk about the role of data in credit risk. So data is the lifeblood of credit risk management. Without good data, even the most sophisticated models produce unreliable results. So, three categories of data drive credit risk analysis. First, historical data, which is the foundation. Analyzing past trends, how different borrowers types behave during previous economic cycles, for example, or which industries have higher default rates, or how quickly risk profiles deteriorate after warning signs. All this provides the training ground for all quantitative models and informs the intuition of experienced risk professionals. Transaction data is more granular and dynamic. Current account balances, payment histories, and spending patterns tell a real-time story. A customer who has always paid on time but suddenly starts making only minimum payments, with increasing spending on essentials and declining discretionary purchases, is sending clear signals. Transaction data enables the detection of these behavioral shifts before they become defaults. And alternative data, which is the newest and most exciting data type. This includes rental payment history, utility bills, mobile phone usage patterns, even satellite imagery of retail car parks to estimate footfall and revenue for business borrowers. The use of high-frequency non-traditional data is expanding the universe of people who can be assessed for credit, particularly important in markets where former credit history is sparse or absent altogether. Let's examine the specific quantitative metrics credit risk professionals use to assess borrowers and portfolios. First metric is debt to income, or DTI. That's for individual borrowers. This is the sum of all monthly debt payment divided by the gross monthly income. A DTI of 30% means 30 cents of every dollar earned goes to debt repayment. Most mortgage lenders set a maximum threshold, commonly around 43%, above which they will not lend. The second is loan to value, or LTV. That's for secured loans. This compares the loan amount to the appraised value of the collateral. A higher LTV means less equity cushion and greater loss in a default scenario. This is why lenders typically require private mortgage insurance when LTV exceeds 80%. The third measure is capital adequacy ratio, which is for financial institutions. This measures how much capital a bank holds relative to its risk-weighted assets. Regulators mandate minimum capital ratios under Basel III to ensure banks can absorb losses without becoming insolvent. Fourth and fifth, for corporate borrowers, earnings stability and metrics like operating margins and return on capital employed are critical. A company with stable, growing earnings and healthy margins is a far safer credit than one with volatile, declining profitability, regardless of what their balance sheet might show at any single point in time. We touched on real-time monitoring as a best practice. Now let's explore how it actually works in practice. The importance of real-time data cannot be overstated in today's fast-moving environment. Markets shift in hours, companies announce bankruptcy with little warning, a borrower's employer can fold overnight. Monthly or quarterly reviews of credit exposures are dangerously slow. Real-time monitoring ensures decisions are based on the most current information available. The tools have advanced dramatically. Modern platforms combine advanced analytics, running continuously on live data feeds, with interactive dashboards giving risk management and managers an instant visual summary of portfolio health. AI-based early warning systems like flag accounts showing deteriorating indicators before a human analyst would notice, which produce actionable alerts with specific causes rather than just a score change. Real-world case studies from retail banking, commercial lending, and trade finance all point to the same conclusion. Institutions that invest in real-time monitoring capabilities catch problems earlier, lose less on defaults, and maintain healthier portfolios than those relying on periodic reviews. The return on investment in this technology is well documented and substantial. Let's look at some of the modern tools used in credit management. Predictive analytics platforms are the computational backbones, which are environments where data scientists and risk modelers build, train, and deploy credit risk scoring models. Tools like SAS, Python with scikit-learn, and cloud platforms from AWS, for example, or Azure, provide the infrastructure to process enormous datasets and run complex algorithms at scale. What previously required a dedicated data center can now be spun up on demand in the cloud in minutes. Machine learning platforms go further, offering automated model selection, hyperparameter tuning, model versioning, and A/B testing of competing score approaches. The goal is to make building and improving credit models faster, more rigorous, and more systematic, reducing the time from model conception to production deployment from months to days. Visualization tools like Tableau and Power BI or custom-built risk dashboards translate raw outputs into actionable intelligence. A well-designed risk dashboard shows at a glance total credit exposure by sector, the number of accounts in each risk tier, delinquency trends over the past 12 months, and any accounts triggering early warning indicators today. Without good visualization, even the best data and models fail to influence decisions quickly enough to matter.